Did you know that there are investment mistakes so common they can destroy years of hard work and cost you thousands of dollars? Even for experienced investors? Most people make these mistakes without even realizing it. But today, I'm going to reveal the 10 biggest investment mistakes and, more importantly, how to avoid them. And pay attention. Mistake number 10 is so common that it might be sabotaging your returns without you knowing. Stick with me until the end to find out. Imagine putting all your money into one single stock, and that company suddenly faces a crisis. You lose everything. That's exactly what happens when you ignore diversification. A lack of diversification is one of the biggest mistakes an investor can make. The solution: spread your investments across different asset classes. Include stocks, ETFs, REITs, and even fixed income like treasury bonds. For example, if the tech market takes a hit, your REITs or dividend ETFs can help balance your portfolio. Diversification is essential to reducing risks and ensuring stability. But diversification won't help if you don't understand the market. Let's talk about that now. Let me ask you this. Would you trust a pilot who doesn't know how to fly a plane? Of course not. But that's exactly what happens when you invest without understanding the market. Many people put their money into stocks or ETFs without even knowing how they work. Before investing, do your homework. Use tools like Investopedia, watch reliable finance channels on YouTube, or read books about the basics of investing. The more you understand, the better equipped you'll be to make smart decisions. Speaking of bad decisions, let's talk about one that many people make: blindly following so-called experts on social media. How many times have you seen videos or posts from financial gurus promising outrageous returns in no time? It's tempting, but dangerous. Many of these influencers don't have the knowledge to back up their claims. Or worse, they're just trying to sell you something. Here's a simple tip: always do your own research. Don't make decisions based solely on trends or what's hot. Investing is serious, and it should be based on solid data. And speaking of bad strategies, the next mistake could be quietly destroying your returns without you even noticing. Many investors want quick results, but the financial markets reward patience. For example, the S&P 500 has averaged about 10% annual returns over the past 50 years. If you only think short-term, you might sell too early and miss out on long-term gains. Adopt a long-term mindset. Invest in growth stocks, ETFs, or dividend funds, and watch compound interest work its magic over the decades. Now, let's talk about something that's quietly draining your wallet: fees and taxes. Fees and taxes can be silent enemies to your portfolio. For example, mutual funds often have management fees that, over time, can eat away at your profits. And if you sell investments before 1 year, you could face higher capital gains taxes. The solution: use tax-advantaged accounts like Roth IRAs or 401(k)s, which offer incredible benefits for long-term investors. Also, choose low-cost ETFs to maximize your returns. But before you even think about investing, there's something critical you need: an emergency fund. Let's move to the next mistake. Imagine this: a car repair, a medical bill, or another unexpected expense comes up. If you don't have a financial cushion, you might be forced to sell your investments, often at a loss. The rule is simple: save 3 to 6 months' worth of expenses before you start investing. This protects your investments and ensures you won't have to make rushed decisions. And speaking of rushed decisions, the next mistake involves trying to predict the unpredictable. Have you ever tried to predict when the market will go up or down? It's tempting, but even the best experts get it wrong. Trying to time the market can lead to unnecessary losses because it's almost impossible to do consistently. Instead, use a strategy called dollar-cost averaging. Invest a fixed amount regularly. This reduces the impact of market volatility and ensures you're always in the game. And if you think that's a mistake, the next one might be costing you a stable passive income every month. Dividends are one of the easiest ways to build passive income. Companies like Coca-Cola and Johnson & Johnson pay consistent dividends, and reinvesting these dividends creates a powerful compounding effect, accelerating the growth of your portfolio. If you're not investing in dividend-paying stocks yet, you might be leaving money on the table. Focus on reliable companies that consistently increase their dividend payouts over time. And now, the final mistake that can destroy many investment portfolios: letting your emotions take over. Fear and greed are an investor's worst enemies. When the market drops, many sell out of fear. When it rises, they buy at the peak out of greed. The result? Losses. The solution is simple. Stick to a plan. Set clear goals and stay focused, no matter what the market does. Remember, the market rewards patience and discipline. Now that you know the biggest mistakes, let's wrap up with one final tip to make sure your strategy stays on track over time. The market changes, and so do your financial goals. If you're not regularly reviewing your investments, you might end up with a portfolio that's out of alignment. Reassess your portfolio at least once a year. Adjust asset allocation, sell underperforming investments, and reinvest where it makes sense. This ensures your investments are always optimized for success. These are the 10 biggest investment mistakes you need to avoid. Which one have you made? Or better yet, which one will you start correcting today? Leave a comment below. I'd love to hear your story. And if this video helped you, don't forget to like, subscribe, and share it with someone who needs this information. Remember, success in investing doesn't come from luck, but from avoiding mistakes and following a clear strategy. See you in the next video.